This video represents the continuation of our March 6th class presentation, and it consists of going over the remaining series of slides, and all these slides pertain to questions and answers regarding responses to audit risks. So let's go ahead and review the first question. Question number 8. The objective of tests of transactions performed as a test of controls is to, again, review the 4 answers, stop the video when you are ready, restart the video, and view the answer slide. Okay, the answer to number 8. The objective of test of transactions performed as a test of control is to, and the answer is D, evaluate whether internal controls are operating effectively. And if we take a look, the key to answering this question is where it says performed as a test of control. So the test of control is testing internal controls. So in this case, the correct answer to 8 is D. Let's go ahead and look at question number 9. When the auditor decides to increase the risk of material misstatement because certain controls were deemed to be ineffective, the auditor would likely increase. And this is where you need to understand how the different risks within the auditor's control risk model interact with each other. So again, take a look at the 4 solutions, stop your video, and when you arrive at your solution, restart the video. Okay, now let's take a look at the answer to number 9. When the auditor decides to increase the risk of material misstatement because certain controls were deemed to be ineffective, the auditor would likely increase, in this case the answer would be D, the extent of substantive testing. And if we take a look at the audit process, we have the inherent risks that then are mitigated by the client's internal controls over financial reporting, and the controls that the risks that are not mitigated become control risks, and the auditor then creates substantive testing to address those control risks. And after that, then there could be the possibility that the substantive testing doesn't reduce or doesn't mitigate all the control risks, and that leads to detection risk, which leads to audit risk. Over the right hand side, you can see this is expressed as an equation. This is the AICPA risk model, and it shows inherent risk is affected by control risk, and these two items combined becomes a risk of material misstatement. We also know that the risk of material misstatement is impacted by in effect, our detection risk, which is a result of our substantive testing. So that results in audit risk. And we can combine it down here as inherent risk times control risk. That quantity times detection risk equals audit risk. That's the same thing as these two lines up here. But we can utilize this audit model and the equation here to respond to these. Now, first thing is if the assessment of inherent risk, that would be the first answer. And in this case, we take a look at it. Inherent risk is impacted by control risk. And we wouldn't change the assessment of inherent risk because basically that's something the auditor has no control over. So the auditor has no control over inherent risk in A. Now we take a look at B, the amount of acceptable detection risk. If we take a look at that, that's a risk of material misstatement is impacted by our detection risk. But we as auditors would be most likely want to keep our audit risk at the same level. So we really couldn't increase the amount of acceptable detection risk and maintain the same at the same level of our predefined audit risk. Three is the extent of the test of controls, and all that would be doing is doing an additional evaluation of control risk when we know control risk has already been evaluated and we know that has resulted in some detection risk. So the last answer is the extent, the amount of substantive testing, which will decrease our detection risk. So if the goals are found to be ineffective, detection risk would also increase. The auditor would likely increase the amount of substantive testing to offset that risk. Let's take a look at question number 10. Regardless of the assessed risks of material misstatement, auditors should perform some. And again, you're given 4 responses. Go ahead, review those responses as you stop your video, and when you're ready, please restart your video. Okay, let's look at the answer to number 10. Regardless of the assessed risks of material misstatement, auditors should perform some, and the answer is C, substantiative procedures to reduce detection risk for significant transaction classes. And again, this is a requirement. This is a requirement to audit standards. Without regard to the assessed risks of material misstatement, in other words, even if we think everything's fine, the auditor should design and perform substantiative procedures for all relevant assertions related to each transaction class, account balance, and financial statement disclosure. So you should also have at least one test that tests each of those financial statements assertion in addition to any of the perceived control risks that are occurring within the company. Okay, let's try question number 11. Number 11, which of the following audit evidence is most persuasive? And again, most persuasive is a key term. You're given these 4 particular pieces of evidence. Go ahead, review the answers, stop the video, and when you're ready, go ahead and restart the video. Okay, the answer to question 11, which of the following audit evidence is the most persuasive? We're given 4 choices, and the answer in this case is C, bank statements obtained from the client. Now remember, when we're talking about evidence, we have 2 major types of evidence. One is called conclusive evidence, and the second one is called persuasive. Conclusive means it is a piece of evidence that is irrefutable and it stands totally on its own. Persuasive evidence is probably a little bit lower level of evidence, meaning that it's persuasive, but it's not truly conclusive, which means typically you have to gather more evidence to support your assertion with persuasive evidence than you do obviously with conclusive evidence. So this is asking which is the audit evidence is most persuasive. So let's take a look at each of these items here and then end up with item C, which was the correct answer. Okay, A, pre-numbered clients purchase order forms. And again, we can see our chart of persuasive evidence here. And the top of the one is the highest in terms of reliability, and the bottom was the lowest in terms of reliability. Okay, pre-numbered clients purchase order forms. Those are internally generated and they're also internally circulated, so they would be at the 4th level. They would be the least reliable and they're therefore least persuasive. B, client worksheets supporting cost allocations. Again, client worksheets would be internally generated and internally circulated, which would also be the 4th level. And then we have D, client representation letter. Again, that's internally generated and internally circulated. We're left with C then as the most obvious choice, but we can also justify it by going bank statements obtained from the client. These would be externally generated, and internally circulated. So these would be, if you will, level number 2. So these would be the most persuasive out of all 4 examples. Let's go ahead and take a look at now question number 12. Okay, which of the following statements relating to audit evidence is always true? Again, you're given your 4 choices. Stop the video, arrive at an answer, and when you're ready, restart your video. Okay, the answer to number 12 is which of the following statements relating to audit evidence is always true? And in this case, the answer is B. Evidence gathered must be reliable and relevant in order to be considered appropriate. And again, you can see our definition of sufficient and appropriate and reliability here as part of our presentation. So with that, let's go on now to question number 13. In evaluating a client's accounting estimates, the auditor would normally be concerned about assumptions that are. Okay, and this basically relates to, if you will, audit risk. So again, look at the possibilities, and when you're ready, restart your video. Okay, let's take a look at the answer to number 13. In evaluating a client's accounting estimates, the auditor would normally be concerned about assumptions that are, in this case, the answer would be A, susceptible to bias. And if we take a look at significant risks when we're evaluating audit evidence, we can take a look at routine transactions as an example, and we can see that under that one of the risks in terms significant risk are a high degree of subjectivity in accounting estimates. So with that then, let's take a look at question number 14. Which of the following audit evidence is least persuasive? Okay, now again, take a look at the answers and stop your video. When you're ready, restart your video. Okay, let's take a look at the solution to number 14. And again, this is we've had this question in another form. I believe it was question number 9 or 10. But in this case, which of the following audit evidence is, instead of most persuasive, in this case, the least persuasive? And the answer in this case is D, pre-numbered shipping orders. Again, if we take a look at the in terms of persuasive evidence, we can see basically correspondence to the auditor from outside counsel regarding pending client litigation. This would be externally generated and externally circulated, so that would be the highest level of persuasive evidence. Number 2 would be bank statements obtained from the client. That would be externally generated but internally circulated, so that would be level number 2. Test counts of inventory made by the auditor. That would be, again, if the auditor's doing the test counts themselves, that would be externally generated and externally, in effect, externally circulated. And the last item would be pre-numbered shipping orders, which would be internally generated and internally circulated, which means that the pre-numbered shipping orders would be the least persuasive. Okay, let's try question number 15. question number 15. Assuming that the auditor has selected pre-numbered shipping orders as a starting point to test for the assertion of completeness in sales, what other combination of audit procedures would provide corroborating information for the assertion of completeness in sales? So again, stop the video, and when you're ready with your answer, restart the video for the answer. Slide to number 15. Okay, let's take a look at the answer to number 15. Assuming that the auditor has selected pre-numbered shipping orders as a starting point to test for the assertion of completeness in sales, what other combination of audit procedures would provide corroborating information for the assertion of completeness in sales? So what we can do here is if we take a look at our transaction flow, if we're doing something with our transactions that is going from our beginning or a previous transaction to a transaction that's leading to the financial statements, that's from top to bottom in this particular case right here, that would be considered typically supporting the completeness assertion. So let's take a look at number 1. Number 1 says trace the shipments to the sales invoices. And again, that would come from the shipping document, so it would come through our transaction. And the invoices, basically the sales invoices, would be basically created as a result of those items, and those would be going from the top down. Number 2, vouch the customer payment of invoices in the accounts receivable ledger to the cash receipts record. So if we go to the accounts receivable subsidiary record, if we want to go back and vouch those records, what we're really doing is going from this point here and going up in the transaction flow. So that would be not a completeness assertion, that would be more of an existence or a valuation assertion. Number 3, if we account for the sequence of shipping orders. Again, typically when we're looking at pre-numbered documents or the sequence of pre-numbered documents, that indicates that they're controlled in a certain way, which means we're basically checking for completeness. Again, we're going from top to the bottom. And lastly, trace the sales invoice to the accounts receivable ledger and then to the recording sales journal. Again, if we take a look, transaction authorization to the transaction source document, the sales invoices, which are eventually posted to the sales journal and the accounts receivable subsidiary ledger. So what's happening in this case, we're going again from top to bottom. So in this case, the answer would be 1, 3, and 4. Now let's look at question number 16. Which of the following presumptions is correct about the reliability of audit evidence? And that means always correct. Again, take a look at the answers, stop your video, and when you're ready, restart the video for the solution. Okay, which of the following presumptions is correct about the reliability of audit evidence? And the answer in this case is D. Effective internal control provides more assurance about reliability of audit evidence. And if we look at audit evidence of presentation, what we say here is audit evidence that is generated internally is more reliable when the related controls to that audit evidence imposed by the entity are effective. So we can trust the audit evidence more, even if it's generated internally, when we know the internal controls that that impact that audit evidence are effective. Okay, let's now try question number 17. Which of the following is not a basic procedure used in an audit? So again, stop your video when you're ready, restart the video for the answer. And in the case of number 17, which of the following is not a basic procedure used in an audit? And the answer is D, test of direct evidence. And if you look at A, risk assessment procedures, B, substantive procedures, and C, test of controls, those are all primary procedures. If you take a look at how we basically in do our risk analysis regarding inherent risks, then control risks, and then our substantiative procedures, and then which lead to detection risks. So the one that doesn't make any sense, even if you don't understand what that term means, would be D. Okay, let's try question number 18. Which of the following procedures would an auditor ordinarily perform first in evaluating management's accounting estimates for reasonableness? So again, you have your four responses. Stop your video when you're ready. Restart your video for your answers. Okay, the answer to number 18 is really kind of intuitive. And when you're going to actually evaluate management's accounting estimates for reasonableness, the first thing you'd really need to do is you wouldn't worry about how management is calculating or anything else. You'd want to obtain an understanding how management developed its estimates. You have to understand the theory, the process, and the procedure, because if that underlying theory behind that process is unsound, you really can't rely on it. And as they say down here, the auditor first needs to obtain an understanding of how management developed its estimates before it considers the appropriate lists of key factors, and assumptions used in preparing the estimates or testing the calculation. Okay, let's take a look at question number 19. 19, in testing the existence assertion for an asset, the auditor ordinarily works from, and now you can take a look at the four answers. Stop your video. When you're ready with your answer, restart your video. Okay, number 19, in testing the existence assertion for an asset, the auditor ordinarily works from, and the answer is C, subsidiary accounting records to the asset. If we take a look at each of these items, A, the amounts represented in the financial statements would be an aggregation of the general ledger accounts, which would make it impossible to trace back to the detailed records. Plus, in effect, it's basically not really possible. B, this would be a test of completeness. C, the subsidiary accounting records maintain the details of all the recorded assets, and tracing the amounts recorded in the subsidiary ledger to the assets does test existence. And D would be this would be a test of the completeness assertion. Okay, let's take a look now at number 20, and I believe this will be our last question. Number 20, a client uses a suspense account for unresolved questions whose final accounting has not yet been determined. If the balance remains in a suspense account at year end, the auditor would be most concerned about. And again, you have four separate answers. Evaluate the answers. Stop the video. When you're ready, restart the video. Okay, the answer to number 20. A client uses a suspense account for unresolved questions whose final accounting has not yet been determined. If the balance remains in a suspense account at year end, the auditor would be most concerned about, and in this case the answer would be A, suspense debits that management believes will benefit future operations. And the reason this would be the most concerning is this would be basically because it's subject to management bias, management judgment. If we take a look at B, C, and D, these are all entries that have or can be verified by the auditor and can be easily reclassified as adjusting entries. So with that, that is the final question in this video. And again, thank you for your time.